Hello friends, you will listen to a meeting between Kate, a financial analyst, and David, the marketing manager, discussing the budget and financial outlook for an upcoming marketing campaign.
You will find the list of business vocabulary used in this dialogue at the end of the video, and below the video in description. Let's proceed. Hi, David. Let's go over the financial projections for your marketing campaign next quarter. We're aiming to ensure that our capital allocation aligns with our projected cash flow and profit margins.
Sounds good, Kate. I'd like a breakdown of the cost structure for this campaign. Could we start by discussing the gross margin we're expecting from this investment?
Certainly. For the projected revenue of $500,000, our target gross margin is 40%. Meaning we're aiming for $200,000 in gross profit, before deducting expenses like overhead, operating costs and taxes. We've set aside 15% of that revenue for marketing, roughly $75,000 in total.
Thanks for clarifying. To maximize our return on investment, ROI, I'd like to ensure we're putting a substantial portion of this toward high conversion channels. Could we adjust the marketing budget to $90,000 to cover some additional variable costs for paid advertising?
That's a reasonable request. If we shift funds to increase your marketing expenditure to $90,000, we'll need to adjust our operating budget slightly. Additionally, we'd be looking to achieve a higher break-even point to cover these increased costs. Have you calculated the expected payback period if we up our spending?
Yes, based on our conversion rates, I estimate a payback period of around 6 months, which would allow us to recover the investment and start seeing net profits by the end of the year. By then, we'd ideally hit our target profitability ratio of at least 20%.
Great. We'll need to factor in the fixed costs and any amortization tied to software tools you'll be using as well. Let's set aside a contingency reserve of 5% of the campaign budget to handle any unforeseen cash outflows.
Good thinking, Emily. That would add a buffer of around $4,500, bringing our total budget to $94,500. I'd feel more secure with that contingency in place, especially as we aim to increase our market share.
I agree. Just to make sure, are you considering lifetime value, LTV, in your revenue projections? Factoring in the customer acquisition cost, CAC, I think it's essential for understanding our long-term gains.
Absolutely. With the increased spend, we're aiming for an LTV to CAC ratio of at least 3 to 1, which should support our long-term revenue goals and create strong cash reserves as we scale.
Perfect. I'll prepare the updated financial forecast and budget variance report to present to the executive team. If they approve, we can finalize everything by next week.
Thanks, Kate. This all sounds solid, and I appreciate you helping refine the financials. With this setup, we're in a great position to meet both our revenue and expense targets.
My pleasure, David. Let's reconnect next week after the executive review. Here's to a successful campaign. Capital allocation, i.e. distribution of financial resources to different areas to maximize returns. Cash flow, i.e. the net amount of cash moving in and out of a business. Profit margin, i.e. percentage of revenue that exceeds the costs of production, used to assess profitability. Cost structure, i.e. the breakdown of a company's fixed and variable costs. Gross margin, i.e. the percentage of revenue remaining after the cost of goods sold, COGS, before overhead expenses. Return on investment, ROI, is a measure of the profitability of an investment, calculated as net profit per investment cost, x 100.
Amortization is the gradual reduction of an asset's book value, often used in reference to intangible assets. Contingency reserve is funds set aside to cover unexpected costs. Cash outflows is money going out of the business, including expenses and investments. Market share is the portion of a market controlled by a company or product. Lifetime value, LTV, means the total revenue expected from a customer over the duration of their relationship with a company. Customer acquisition cost, CAC, means the total cost of acquiring a new customer, used to determine marketing efficiency. Cash reserves are funds set aside to cover unexpected expenses or downturns. Financial forecast means an estimate of future revenue, expenses, and financial position. Budget variance is the difference between budgeted and actual figures used to analyze performance. Expense targets are predetermined limits for spending within specific categories or departments.
Ladies and gentlemen, that brings us to the conclusion of today's lesson. Thank you for your attention. We hope you found the information shared valuable and insightful.
As we wrap up, I would like to emphasize the importance of incorporating new business vocabulary into your daily communication. For optimal results, I encourage you to revisit this video and review the key concepts discussed. Take note of the new terms and phrases presented, and make a conscious effort to integrate them into your conversations and written correspondence. Remember, language is a powerful tool that can elevate your communication skills and set you apart in the business world. By mastering new vocabulary and utilizing it confidently, you can enhance your credibility and make a lasting impression on colleagues, clients, and stakeholders. So, as we come to the end of this session, I urge you to continue practicing and honing your language proficiency. We look forward to seeing the positive impact of your enhanced vocabulary in your future endeavors. Good luck, and may your newfound linguistic skills propel you to greater success in the business world.